Despite the previous week's stock market rally, stocks have reversed and ignited fears of a stock market recession. You had the S&P 500 down 1.3% on the week. You had the NASDAQ 100 down 2.5, and then the NASDAQ Composite down 2.8. And the Russell 2000, which actually held up much better than the NASDAQ indices, was down 1.9, splitting the difference between the NASDAQ and the S&P 500. In this video, I'm going to provide you with my technical analysis on the major indices like the S&P, like the NASDAQ, and the Russell 2000. But first, make sure you pound that like button and subscribe to this channel so you can be notified of all my future videos. And make sure to click join down below so that you can get all of my stock market research each and every day. Now, while the stock market was down, not everything went down with it. You had huge strength in energy. You had a lot of strength in utilities. You had tons of strength in the materials sector as well as real estate. But what was really dragging the stock market down was discretionary. It was technology and the financials or the banks. Interest rates go down, the financials are going to go down with them. Right now, the focus is on Russia and the Ukraine conflict. So naturally, these rates are going to continue to go lower until the focus shifts back into the Fed and the fact that they're going to be raising interest rates consistently throughout this year. Now, the reason why you can have such weakness in the stock market, yet so many sectors that actually rallied this week is because tech and discretionary are huge. You have the FANG stocks that have immeasurable impact on it, and they weren't even down that much. Like you take Apple, for instance, it was only down 1.1% relative to the 2.5% in the NASDAQ 100, or Google, which was down 1.9%. You have Tesla, which is over 800 billion in market cap. It was actually up on the week as the electrical vehicle stocks managed to rally and catch a bid. But because these stocks are so influential, their weakness can outweigh a lot of market strength. And right now, you're not necessarily seeing people go to cash. Instead, people are just simply rotating. They're rotating out of tech, they're rotating out of discretionary and financials, and they're going into energy and materials because of the conflict in Ukraine. That's become a more safety stock. Gold, silver's rallying. Because of inflation, you have commodities like wheat that is soaring. So there's not a major panic in the market at this point where people are saying, let's go to cash. I'm done with this. I'm just going to sit this one out. They're still trying to make a buck by rotating into something different. You have two safety stocks, utilities and real estate, that you saw some rotation into as well this past week. But for the most part, the strength was coming from energy and materials. And materials have been up 5 straight weeks. Now, this week, it's a big report that's coming out, the Consumer Price Index. This has the ability to tank the market, even crash it if it comes out too strong. This is what's going to gauge the inflation in the market. Last month, it was 7.5. There's a very good chance that it could be over 8%. Now, last month, it beat expectations coming in at 7.5. But since then, you've had wheat and oil, huge drivers of economic inflation, soar in the month of February and continuing into the month of March. The report will be based on the month of February. And in the month of February, wheat soared 23%. That has a huge impact on food costs. You had oil that was up 8.5% in February. Now, March doesn't look to get any better either unless there's a significant pullback between now and the end of the month. So while there's still a lot of people out there that want to call for a stock market bottom, that the selling's been overdone and that we can rally for the rest of the year, it's premature because you haven't seen real panic in the market where instead of going into energy, materials, and utilities and staples and other sectors away from technology and discretionary, you just have a move straight to cash. That hasn't happened yet. That's where you get your capitulation in the market, and that's where you finally start getting your true bottom, whereas the panic truly sets in because people can't take the losses anymore. Instead, we still have this money-making mindset in the market where people, if tech's not working for them, they're going to go into the next hot sector. But enough about me and my opinions. Let's get straight to the charts and start analyzing what we're seeing in the indices. First up, we have SPY. Now, I've been talking about this pattern for a long time. It hasn't quite confirmed. We had a little bit of a confirmation in February, but it was quickly bought up. And like what we've seen with most head and shoulders patterns, the market rallies. At least that's been the case for about the last 10 to 12 years. But right now, you still have this bearish head and shoulders pattern that confirmed for a quick moment and then bounce right back up. But in the process, you have this bear flag that's now forming close to breaking down as well to the downside. So head and shoulders pattern, that's going to be this left shoulder here. Then you got the head. Then you got the right shoulder. We confirmed it just for a minute here, but that's what oftentimes happens initially with these head and shoulders patterns. You sneak below the neckline and then it bounces right back up. But the bounce wasn't that great. Initially, the intraday reversal was strong, but from a day-to-day standpoint, it wasn't that strong of a bounce. And we're not seeing the same ferocity of buying that we saw back in January's lows when they were attained. So 2 attempts here to break below the neckline. Neither of them have actually sustained to the downside. Now you're getting a test again on Friday. It managed to bounce for a little bit. Monday will be key, and going into the CPI report on Thursday will be defining for this market going forward. Now, the last point that I want to pull up is this declining trend line off of the January highs. It's been tested twice so far, once here in January and again in February, but we haven't got close enough to testing it here in the month of March. Still possible, but for me, I would use this rally to take profits on long positions going into this resistance level and then let it come back down again. And you can also make the case that we have started a downward channel, the lows that have been struck in January and February rallying off of this declining channel band. Now, the picture is very similar in the Qs, except it actually has confirmed this head and shoulders pattern by trading still below it. Here you have the neckline, the left shoulder, the head, and then the right shoulder here, confirmed with the break on Thursday and a continuation to the downside on Friday. Can it sustain that momentum and not continue to confuse investors by going above and below that neckline? That remains to be seen, but the CPI report, again, will be huge for the Qs, probably even more so for the S&P 500 as this declining resistance level continues to weigh down on the stock. Now, going to IWM, much different picture, not nearly the same as what we're seeing on the other indices with the NASDAQ and with the S&P 500. You have a lot of significant resistance going across, going back to March of 2020. That has held firm for about a year now. And you have a double bottom that was starting to form, look like it might break out. I mean, prior to Thursday's sell-off, I'm thinking to myself, this could actually happen. We could see a breakout of IWM confirming this double bottom pattern. But instead, we got the weakness on Thursday and Friday, which throws that into doubt. Plus, now you have the declining resistance below this huge price level resistance. So in order for it to even get close to breaking above and confirming this double bottom, it has to first break this declining resistance, which has been stubborn up until this point. The takeaway in all of this, for the week ahead, what are we to expect? It's going to be volatile. It's going to be volatile just like last week where you had a lot of price choppiness, a lot of uncertainty, headline risk that's going to create buying pressure and selling pressure all throughout the week. The big event's going to be the CPI report. That's going to be the game changer, because if the CPI and the core CPI come in hot, let's say it goes over 8%. Right now, the expectations is 7.8%. But if it exceeds that, you're going to have a lot more talk again about raising the interest rates in March by 50 basis points instead of 25 basis points. If that happens, you're going to see the 10-year yield go straight up. And from what I would expect, the stock market to continue its path lower, sparking new inflation fears. So what can we do as traders? Well, first, what I plan to do is continue to trade fewer positions. That's helped me out tremendously here in 2022. I'm also going to trade less frequently. I don't want to take every trade that I see. Even if it's a good trade setup, if the market conditions aren't aligning perfectly right with them, I'm likely to pass, especially to the long side, because there's so much headline risk on these stocks that just because it breaks out one day does not mean it's going to continue into the next. So we have to take some profits along the way, be aggressive with the profits, and be cognizant of the resistance levels in the technical analysis on the broader indices and how that might affect my individual holdings. If you enjoyed this video, again, make sure to click the join button so you can get all my stock market research each and every day. Plus, pound the like button and subscribe to this channel so you can get updated every time I post a new video, which is a few times a week. So it's great stuff. Make sure to check out the community tab because I'm always posting charts there as well. Thank you guys, and God bless.